Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 3. This is Section E3. This is an evaluation topic. Test the ending inventory quantities in an audit by obtaining evidence regarding the existence and condition of inventory and inventory held by others. So that'd be things like inventory counting procedures and confirmation. And conclude whether inventory records accurately reflect count results. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's free, it is 1 hour long, and we will teach you the key ingredients to passing the CPA exam in just that 1 hour. After you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. SuperfastCPA Pro members get access to the full versions of these videos. In today's video, we're only going to be going over 5 questions, but SuperfastCPA Pro members will get access to the full 10-question version of the video when we post it in the member forum. So if you like this and you like our other products, make sure you check out becoming a SuperfastCPA Pro member. Now with all that, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out if it's a possibility, this is a very good strategy for test day, is to read the last sentence of the question first. Read the last part first, because very frequently that will give you context for what the question is about. You know, it'll kind of tell you this is roughly what the question is going to be about, so that as you're reading through the rest of the question, you already have an idea of what you are needing to know to be able to get the correct answer. So let's do that here. Which assertion is the auditor most likely testing with this procedure? Let's go up to the top. During the audit of Bronson Parts Co., the auditor is testing the ending inventory balance. To verify the validity of the amounts listed in the client's inventory records, the auditor selects a sample of items from the inventory schedule and traces them to the related inventory tags and the auditor's recorded count sheets. So this is what the auditor is doing. What assertion are they most likely testing by doing this? Let's go through the options. Option A, rights and obligations. Option B, valuation and allocation. Option C, existence. Or option D, completeness. So we've kind of been talking more about the assertions lately in the most recent videos. So you might have kind of an idea about what each of these is about. If you have any idea or kind of want to give this a guess, go ahead and pause the video. But if you don't really know what's happening here, that's okay. We're going to use this question to start learning. So let's go ahead and take a look at the explanation if you haven't already paused the video to figure it out on your own. All right, here we are at the answer C, existence. That's what they are testing with this procedure. So let's go through the explanation. By tracing from the inventory schedule, so the client's internal records, to supporting documentation like inventory tags and the auditor's count sheets, the auditor is testing whether the recorded items actually exist. This addresses the existence assertion. The term validity in this scenario refers to whether the listed inventory is genuinely present, not just recorded. So if you ever see something that says validity or valid, typically that is referring to existence. So those are kind of interchangeable when it comes to that assertion. Completeness would involve tracing in the opposite direction, from the warehouse floor to the records, to ensure that all existing inventory is included, not that it exists, but that it's included. Valuation concerns pricing, costing, and obsolescence, so that wasn't what they were testing right here. And rights and obligations involves determining whether the client legally owns the inventory, not whether it physically exists. So if you see an auditor who is tracing from the amounts that are listed in the client's records to the related inventory tags and the auditor's recorded count sheets, you know, like what the auditor actually recorded, then that is going to be testing for existence. Now let's go to the next question. All right, here we are at question 2. Again, we're going to read the last sentence first. Which of the following best describes the auditor's responsibilities in this situation? Let's go up to the top. During the audit of Century Lighting Co., the auditor is evaluating how to obtain sufficient appropriate audit evidence regarding the existence of inventory. The company has several warehouses where most of its inventory is stored, as well as a small quantity of product held by a distributor on consignment. So again, which of the following best describes the auditor's responsibilities in this situation? Let's go through the options. Option A, the auditor must perform physical counts of all inventory, including that held by third parties. Option B, the auditor may rely on management's representations for all inventory locations if internal controls are strong. Option C, the auditor should send confirmations for the inventory held at Century's warehouses and observe the consignment inventory count. Or option D, the auditor should observe the physical count at the warehouses and confirm the existence of consignment inventory with the third party. So again, we're kind of seeing here the difference here where there's a lot of inventory in the warehouses and then there's some on consignment. How is the auditor supposed to verify this? How are they supposed to do this? Are they supposed to physically count all of it, or can they send confirmations for some of it? You know, how does it work? If you don't know, that's okay. We're going to go ahead and take a look at the explanation to learn about this. All right, here we are. The answer is D. The auditor should observe the physical count at the warehouses and confirm the existence of consignment inventory with a third party. So we're going to kind of learn the difference there. When inventory is significant, you know, like most of the inventory is in like a warehouse or something like that, and held by the entity, auditors are generally required to observe the physical inventory count unless it is impracticable, or basically like you can't really do it. In contrast, for inventory held by third parties like consignment inventory, the auditor can obtain confirmations from the third party especially if the quantity is insignificant or observation is not feasible. So if, it's kind of a small amount that's on consignment, then it's okay if you send a confirmation to the third party that has that on consignment. But if it's, big inventory, like it's significant inventory and it's in the client's own possession in their warehouse, then the auditor should observe the physical count. Now let's go through the other options and why they weren't quite right. Option A is incorrect because auditors typically do not perform physical counts themselves or for third-party locations. They observe the physical counts, but they don't do them themselves most of the time. Option B is incorrect because management's representations alone are never sufficient audit evidence. And we've talked about that in a lot of different videos. And option C reverses the appropriate approach, so the total reverse. Confirmation is not suitable for inventory physically present at the company's own warehouses. Again, that's really only suitable if it is on consignment, like it's at somebody else with a third party, and it's, not very significant. With that, let's go to the next question. All right, here we are at question 3. Which of the following situations would most likely lead the auditor to request that the physical inventory count be performed at year end rather than before? So let's go up to the top. During the audit of Mendelsohn Tools, the auditor is considering whether to allow the client to conduct its physical inventory count before year end. The company's inventory is material to the financial statements. So again, which of the following situations would most likely lead the auditor to request that the physical inventory be performed at year end rather than before year end? So let's go through the options. Option A, the client maintains detailed records of inventory quantities and costs. Option B, the auditor plans to test inventory valuation and costing methods. Option C, the client's perpetual inventory system is not reliable for audit purposes. Or option D, the auditor identified a high risk of obsolete inventory earlier in the year. Now again, we're using these questions to learn, so if you have no idea, that's okay. But if you want to kind of give it a guess, maybe pause the video, and when you're ready, come back. We'll look at the answer together. All right, here we are at the answer. C, the client's perpetual inventory system is not reliable for audit purposes. That's, in this situation, the most likely reason why they would request that they do it at year end. So let's kind of talk about this and talk about perpetual inventory systems. If the perpetual inventory system is not reliable, which, by the way, the perpetual inventory system is basically a system that is constantly updating. When stuff leaves, it is updated. When stuff comes in, it's updated. It's like constantly being updated and constantly changing. So if that is not reliable, then the auditor cannot safely rely on roll forward or roll back procedures to bridge the gap between a pre-year end count and the balance sheet date. In such cases, the auditor will likely request a year-end physical count to ensure sufficient evidence of existence and completeness as of the reporting date. So essentially, if they can't really rely on the perpetual system, like if it's not very accurate or it's not very reliable, then the auditor can't really rely on that and kind of like use procedures to kind of go back and see, okay, this is probably accurate, in this period of the year, this is what the amount would have been and things like, they can't really do that if they can't rely on it. So they wouldn't really want the client to do a physical inventory count before the end of the year because, there might be some stuff that happens between that count and the end of the year, meaning that something could be wrong because it's not very reliable. So the auditor wants it to be as close to the end of the year as possible so that it is as accurate as possible. Let's go through the other options. Option A would support an interim count. If the client maintains detailed records of inventory quantities and costs, then the auditor probably can let them do the physical inventory count before the end of the year. Option B relates to valuation, not count timing, not the timing of when you do the count. And option D may influence audit focus, but doesn't necessarily require a year-end count. All right, let's go to the next question. All right, here we are at question 4. This analytical procedure most directly helps the auditor assess which of the following. So let's go up to the top. As part of year-end audit procedures, an auditor performs an analysis of inventory turnover ratios by comparing current year turnover to prior periods and industry benchmarks. The auditor notes that several product lines have significantly lower turnover than in previous years. So this analytical procedure most likely directly helps the auditor assess which of the following. Let's go through the options. Option A, the condition and potential obsolescence of inventory. Option B, whether inventory was recorded in the correct period. Option C, whether the inventory is properly classified as current or non-current. Or option D, the client's ownership rights to the inventory. So again, with this procedure where they're performing an analysis of the turnover ratios for the inventory, what is this going to help them understand? If you don't know, that's okay. We're going to look at the answer right now. All right, here we are at the answer. A, the condition and potential obsolescence of inventory. That's most likely what they're testing when they do this turnover ratio procedure. So let's go through the explanation. A low inventory turnover ratio may indicate that inventory is slow moving, obsolete, or impaired, which directly affects its condition and potential valuation. Maybe it's damaged or maybe it's old, so the condition isn't very good. So that would potentially be a reason why the inventory turnover isn't very high. Analyzing turnover helps the auditor identify items that may require a write-down to net realizable value. Let's go through the other options. Option B was referring to cutoff, which would involve reviewing receiving and shipping documents, not looking at the turnover ratios. Option C involves classification, which is not directly assessed through turnover analysis. And option D relates to rights and obligations, which would require reviewing titles, invoices, or contracts. Again, that would be for checking the condition and potential obsolescence of inventory, as we just learned. Now let's go to the next question. Okay, here we are at question 5. Which of the following is the most appropriate response by the auditor? Let's go up to the top. During the observation of the year-end physical inventory count at one of Central Timber Co.'s warehouses, the auditor notes that 150 units of lumber are physically present, but the client's inventory records only show 100 units. When asked, the warehouse manager explains that a recent shipment of 50 units was received the day before but has not been entered into the system. So which of the following is the most appropriate response by the auditor? Let's go through the options. Option A, accept the warehouse manager's explanation and proceed with testing other inventory items. Option B, inspect receiving documentation and trace the shipment to the receiving log and vendor invoice. Option C, perform test counts of additional inventory items in the warehouse to determine if other overstatements exist. Or option D, adjust the final inventory balance by adding the 50 additional units. So what should the auditor do if there's this discrepancy between what the auditor sees and what the client's system says, and also the claim that the client gives? If you want to think about this and kind of give a guess, pause the video. If not, let's go ahead and take a look at the answer together right now. All right, here we are. The answer is B, inspect receiving documentation and trace the shipment to the receiving log and vendor invoice. So that's what the auditor would most likely do here. Let's go through the explanation. When a discrepancy arises between the auditor's physical count and the client's inventory records, and the client provides an explanation, the auditor should perform procedures to verify that explanation. In this case, the appropriate response is to inspect the receiving documents to ensure the 50 units were actually received and simply not yet recorded. So they want to make sure that they can verify what the client is saying. Option A is inappropriate because an explanation alone is not sufficient audit evidence, and we've talked about that in a whole bunch of different videos. Option C may be helpful later, but doesn't directly address this specific discrepancy. And then option D would involve making an audit adjustment based on unverified information, which is premature. The auditor shouldn't do this yet. They still need to verify if this is all correct. And with that, we've gone over the first 5 questions in this video. Remember, we're going to go over an additional 5 questions in the member version of the video. But before we do anything else, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen multiple questions trying to teach you how an auditor should respond to a discrepancy or whatever the case is. Again, these are the things you're seeing in the questions. And so you write down what you're seeing the most in your own words as the Pillar Topics. And as you're doing this each day, you're building your own personal repository of the most important things you learned in your own words from the questions that you went over to prepare for the exam. So that, again, you know what is important and you are ready for the exam. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, tracing for existence. That was one of the first things we talked about. To verify the existence of inventory, auditors trace from the inventory listing to physical inventory tags or count sheets to confirm that recorded amounts are valid and present, that they actually exist. Now let's talk about observation versus confirmation. Auditors are generally required to observe physical counts of significant inventory held by the client, but may use confirmations for inventory held by others if direct observation is impractical or unnecessary, like if it's just too small to take the time to go do that. Now let's talk about year-end counts and why this would be affected by a perpetual inventory system. If the client's perpetual inventory system is not reliable, and again, a perpetual inventory system is a system that constantly is updating. It's not periodic where they only do like every once in a while they check how much inventory there is. This system is constantly changing. If it's not reliable, the auditor cannot rely on roll forward or roll back procedures and should request that the count be performed at year end, again, to kind of try to make sure that it is as accurate as possible. Now let's talk about turnover analysis. Analytical procedures like inventory turnover comparisons help auditors assess the condition of inventory and detect slow-moving or obsolete items that may require a write-down. Now let's talk about the final one, resolving discrepancies. When physical counts differ from the client's records, or maybe if there was another kind of discrepancy, auditors must perform procedures such as inspecting receiving or shipping documents to verify the client's explanation before making any audit conclusions. And with that, those were the pillar topics. Those are kind of like the basic ideas that we learned in those 5 questions. And that is the end of this YouTube version of the video. Remember, again, we only went over 5 questions, but SuperFast CPA Pro members are going to get access to the full 10-question version of the video that I'm about to finish making after this in the member forum. So if you like this and you like our other products, check out becoming a SuperFast CPA Pro member because you'll get access to a lot of great stuff, including the Pro course, where Nate explains in detail exactly what you're supposed to be doing every single day to pass the exams. It's kind of a more in-depth version of the 1-hour webinar, and you will also get access to the full versions of these videos. So make sure you check out becoming a pro member, and the easiest way to do that is actually by going to superfastcpa.com and signing up for our free 1-hour webinar training, You'll learn a lot there. It's well worth your time to spend that hour, and it will give you a good path, a clear path to becoming a pro member if that is what you want to do. So make sure you check that out as well. I hope this video was helpful. If you liked it, make sure to like it and leave a comment, and I will see you in the next video.